It's our pleasure to welcome all of you and to introduce the founder and president of the Breakfast Club New Jersey, Frank Kovacs.
Good morning, everybody. I see many familiar faces, so many of you know the Breakfast Club was formed after 9/11 tragedy to help those that lost their jobs. Over the years, there's been a lot of financial, economic strife in the country that's made us stay in business in order to help others. Unfortunately, with the inflation today and the implications of that on many corporations, we're seeing a huge downslide in the tech bubble with most of the major firms there, with the exception of Apple right now. We're seeing the downsizings at Meta, the downsizings at Twitter. These are unfortunately going to be more prevalent as in the coming year, unfortunately, unless some dramatic turnaround happens. The inflation impact means that consumers just have less funds to spend. That means that these companies have to vie that much harder, for their products and services. And with that, there'll be losers, which again will be more ripple effects in, unfortunately, people losing jobs. So that combined with digital transformation and the impacts that it has displaces a lot of the workers, and unfortunately, upskilling and reskilling, which requires a lot of effort on behalf of the job applicant, has to take place in order to demonstrate the proficiency and competency for many of the jobs that result. So the Breakfast Club is here to help our members navigate, all of that. We try and have very pertinent content month over month in our programs that we present in order to help people be successful in those job search efforts. Addition to that, the club itself is free. It's all pay it forward. Many of the people you see even on the screen today are volunteers who are part of the Breakfast Club's administration. The whole thing is you need to build a very sound network of people that you can rely on. And that's one of the big factors that the Breakfast Club has, both through our meetup, through our LinkedIn group, through our Facebook group. Please take advantage of that. With the volume of people that we have, we increase the probability of success in either knowing somebody who either works at the targeted company, has worked there before, or knows somebody there that can help you. And that's the number one way a job is found. This month is open enrollment month for benefits. And, we try every year to have Bill LaChance come forward and talk to everybody. He's very well skilled and knowledgeable in every aspect of the open enrollment and financial planning in general. So, very worthwhile information to everyone, whether you're in job search or not. And that's what we try and do, is bring the content that's going to be useful and helpful, and hopefully make you that much stronger in your pursuits. So with that, I'll turn it over to Jerry Payton. Jerry will make the introduction, and I hope you enjoy today's program.
Thank you, Frank. Good morning, everyone. Hope everyone's doing well. Let me introduce today's speaker. We have a great discussion today, and a very valuable presentation with a lot of key facts that you're going to need, especially if you happen to be unfortunate and have to run into lose your position and have to make these number of these financial decisions. Let me introduce today's speaker. Bill LaChance is an independent financial advisor. Bill's firm offers a unique flat fee program that combines financial planning, investment management, tax planning, and tax preparation. Prior to launching his financial planning practice, Bill spent 22 years in corporate finance in the retail industry, and before that was a CPA with a large accounting firm. Bill is a certified financial planner as well as an enrolled agent authorized to represent taxpayers before the IRS. I'd like to introduce Bill.
Morning, everyone. Here, I'll share my screen here. I think I need to be authorized to share the screen. There we go. All right, and then I'll start the presentation. That should show up, right? You should see me a black screen now. Let me get the thing here. And you guys see it okay? Money saving strategies?
I see it.
Yes,
Okay.
yes, we do.
All right, so this presentation, good morning, everyone. This presentation isn't necessarily designed to be everything you'd ever want to know, during a job transition financially, but I tried to hit items where maybe you weren't fully aware of all that was going on. So we'll kind of go through it. And as David said, it'd be, just go ahead and ask questions along the way. I've always found that to be better when doing this. So whether you want to just jump in and ask or, put something in the chat, that would be totally fine. Okay. So we'll start with health insurance. As Frank had mentioned, this is open enrollment season for health insurance. So if you hadn't signed up on the exchange previously, you certainly can now. Don't really need a reason anymore. Outside of open enrollment, you need a reason to do it, but right now you don't, and anybody can sign up. And really, if you're in a job transition and you're not covered with insurance through a spouse or a significant other, really you have two options, right? One is COBRA, and the second option is the exchange. And a lot of it, whether one's going to be better than the other, ultimately depends on whether you're going to qualify for a subsidy on the exchange. And people tend to dismiss it and think, oh boy, I got to get to 65 till I get to Medicare because I don't want to be on exchange. But exchange insurance, actually works for a lot of people. I had it myself for a number of years. And if you can get a subsidy, if you can manage your income, you can get, quite a bit of financial help. And the big change that's happened in recent years is that when COVID hit, there used to be a cliff. And so essentially, if you were over the cliff, you lost all your insurance. And so, for example, for a family of four, the cliff was right around $104,000 of adjusted gross income. So if your income was going to be over $104,000, you lost the entire subsidy. It could be worth, $14,000, right? Just being $1 over. In 2020, because of COVID, they basically, for 2 years, for 2021 and 2020, 2021, they eliminated the cliff, or through 2022 rather. They eliminated the cliff, and then they made it more of a sliding thing, where it was basically 8.5% of your income. The assumption is that 8.5% of your adjusted gross income could go to pay for health insurance. So as your income goes up, the amount that you pay goes up by 8.5%. So it's really a sort of a marginal tax rate of 8.5% is what it ends up being. And you can see there, this chart here has what those limits are, and it could be quite high. I mean, for a family of four, in theory, a family of four with $370,000 of income could just qualify for a subsidy. So now it's pretty significant where you get it. And what this premium subsidy is a tax credit. You estimate your income for the upcoming year, and then depending on where it goes, if you come in right on that number, there's no adjustment. If your income comes in over that number, you're going to have to pay some of that subsidy back. If your income comes in under that number, you're going to get more subsidy at tax time in the form of a credit, meaning you'll get a higher refund or you'll owe the IRS less. So that's essentially what it is. There's a second subsidy called a cost-sharing subsidy. And what that does is that lowers the cost of your co-pays, your deductibles, that sort of thing. That does not get trued up. So if you're not sure what your income is going to be, you want to, estimate low, as long as you can justify. You can't just make up a really low number, but assuming that you can justify, let's say your only income right now is unemployment, and you put that unemployment in, and that qualifies you for a cost-sharing subsidy, well then, you might as well put that in. It's certainly possible you'll get a job, at some point in the following year, and then you would obviously have to pay potentially some of that back, but you wouldn't have to pay the co-pays and the deductibles back. So I generally advise people, if they're in that situation, are not sure what their income is going to be in the upcoming year, because what you're forecasting is the future year. So like right now, if you signed up for 2023, you're estimating what your 2023 income is going to be, not your 2022 or 2021 income. I mean, it only matters to the degree that the IRS has your 2021 income. So if it's what you put in for 2023 is a lot different than 2021, they'll, Get Covered New Jersey will ask you, right, why it's different, but you could just explain it essentially. And the reason I bring this up is I literally have financial planning clients that have, significant assets, right? $3-4 million of assets that are getting subsidized health insurance because they're able to manage their income low, right? By drawing down, out of savings or something else where that doesn't generate income essentially. So it's available for a lot more people than I think people realize. The one sort of thing that is potentially an issue, and this is really sort of unique to New Jersey, is that, especially northern New Jersey, although I guess it's southern New Jersey as well, is that most of these networks are EPOs, meaning you have to stay in network, and they generally don't include out-of-state physicians. So, for example, if your doctor's in New York, they may not be in network in these plans. Same thing in South Jersey. If your doctor's in Philadelphia, they may not be in network. You generally have to stay in New Jersey, essentially. So that's probably the one sort of caveat for that. The other, New Jersey added a little bit subsidy in 2021 to add, an extra $100 or $200 a month. That also does not get trued up at tax time. The cost sharing subsidy that I was talking about, which is really that orange sort of band, that really only applies on silver plans. So they have like 3 tiers of plans: bronze plans, silver plans, and gold plans. And essentially the way it works is the bronze plans have the lowest premium but the highest out-of-pocket cost. Silver's in the middle, and gold is the opposite. But in theory, they're actuarially equivalent for the insurance companies, meaning the insurance companies are indifferent whether you take bronze, silver, or gold. You're either going to pay the higher premium and lower out-of-pocket, or vice versa. And with enough people in the plan, it should work out on average that insurance companies indifferent, or they end up in the same place either way. Although it could differ by you based on your specific situation, favoring one or the other. But if you are going to have your income low enough to qualify for a cost-sharing subsidy, then you want to be, those are only available on the silver plans, the middle tier, basically. And then that green bar on the left, that puts you, if your income is below those thresholds, that takes you out of the Get Covered New Jersey, Affordable Care Act plans and into New Jersey Family Care, which is Medicaid. There, everything is free. The issue that some people have is that the doctor network is much more limited on Medicaid because the reimbursements are so low. And so I do have folks that actually try to manage their income up over that Medicaid threshold so they don't end up on Medicaid. And you could do that just doing a Roth conversion, which I'll talk about later, as a tool to manage your income up. So there's that. And as I mentioned, we're in an open enrollment right now. It's going to run through January 31st. So really, though, if you are thinking about a plan for 2023, you want to probably sign up by December 15th would be my recommendation. And then the higher income limits that I talked about. So any questions on any of that? Nope. Okay. Couple other things on the health insurance. So as I mentioned, right, this American Rescue Plan. Oh, so basically the original COVID plan went through 2023, but now with the American Rescue Plan, the Inflation Protection Act plan, that just got passed, in the fall, that actually extends this out into 2025. So at least 3 more years, right? You're not going to have to worry about that cliff. Beyond that, we'll see what happens. But and then they also bumped up the credits for those who were under. It used to be 400% of the poverty level was the cliff, threshold, and they also improved the credits for folks under the 400% threshold. Okay. A couple other comments on medical. For those who have an HSA or are familiar with HSAs, right? HSA is a health savings account. You have to be in a specific high deductible plan that really pays nothing until you meet your deductible, right? That's essentially the criteria. It does not just a high deductible plan. It also has to be a high deductible plan that has specific criteria. But if it qualifies for an HSA, you're allowed to put up to $3,650 for an individual. Those are the 2022 numbers, and it'll probably bump up for 2023, and then $7,300 for a family. You could put that in and then take a tax deduction. And then, or if it's pre-tax, if you get it through work, it's just pre-tax. You don't pay tax on it. But unlike an IRA or a 401k, when you take the money out of an HSA, as long as it's used for medical expenses, you don't get taxed on it. So it's not tax going in, not tax coming out. So it really is a really sweet deal to do an HSA. And so again, for my financial planning clients, I generally recommend that they max out the HSA even before they max out a 401k or an IRA, because you'll eventually, even if you have excess in there that you're going to need, you can invest it in the mutual funds, just like you would in an IRA, and save it for the future. And then you can use money for the HSA to reimburse yourself for your Medicare premiums. So you'll eventually use it up. And the worst case scenario is if you wait till 65 to take the money out and you don't use it for qualified education expenses, you have to pay tax on it, but you don't have to pay any penalty. So it's no different than if you had taken money out of an IRA or a 401k. So it really is a sweet deal. So one law that's out there is you can, once in your lifetime, switch from move money from an IRA to an HSA. I'm sorry, do you got a question? Or?
You said qualified educational expenses. You meant to say medical, right?
Oh, qualified medical expenses. I'm sorry. I apologize. Yeah, qualified medical expenses. Correct.
Will, one question. This is one in a lifetime per person or per family?
So if you're in a single plan, so if there's one person in the plan, the limit's $3,650. Although there's another $1,000 catch up, right? If you're over 55, so it's really $4,650 if you're over 55. If you have more than one person in the plan, anywhere from 2 into whatever number, then you qualify for the family plan limit, and that's $7,300, which you get another $1,000. So you're $8,300 for you, but then also your spouse could put in $1,000 as well if they're over 55. So really, for 2022, the max would have been $9,300 if you had 2 spouses over 55. That's the amount you can put. So it depends on how many people are on the plan. Make sense?
Yes. Yeah.
Okay. But anyway, they do allow a once in a line. I did this. Again, you're better off if you have the cash available to fund the HSA and take the tax deduction. But if you don't, you can move money from your IRA to the HSA and basically get the money out of your IRA tax-free by running it through the HSA, essentially. And you can do it once in your lifetime up to the annual limit, right? One thing is if you get more than 10% of your income is used for medical expenses, or sorry, more than 7.5% of your adjusted gross income is used for medical expenses, you can take money out of your IRA or 401k and not have to pay the penalty if you're under 59.5. I'm assuming most of you are aware, right, that if you're under 59.5, if you take money out of your IRA, you have to pay a 10% penalty on top of the tax. However, if it's used to cover medical expenses more than 7.5% of your adjusted gross income, you don't have to pay the penalty. And
Bill, there's one caveat to that. If you deduct the medical expense on your taxes, if you take money out of the IRA, that counts against what you've deducted.
That's correct, right? You can't double dip. You can't get double tax benefit. That is correct. So you'd have to make that decision about whether you're deducting it for it or pulling it out of the HSA. That's correct. The withdrawals from an IRA and not a 401k, if used to pay your medical insurance premiums, if you've been on collecting unemployment for at least 12 weeks, then that also you could take out. So essentially you're saying, listen, if you're unemployed and now you're having a difficult financial position and you need to take money out of your IRA to pay for your health insurance premium, as long as you've been unemployed for 12 weeks, right, then you don't have to pay that 10% penalty. Another exception. But that's only true for IRAs, not 401ks. So if you're in that situation, you'd have to roll the money from the 401k over to the IRA first. Any other questions on medical stuff? Okay. Then we get into some issues that, I just kind of went through. There was a whole series of tax law changes over the last few years. And I just kind of hit some of the highlights, right, of what's still applicable, right, these days. So the CARES Act, which was passed back in 2020, they did include, expand certain over-the-counter medications to be eligible for the HSA FSA. Then the Appropriations Act, which came out in 2021, there was, and it's really, I suppose, gone. I probably should have pulled this out. $600 charitable deduction, which was for 2021. That is not going to apply for 2022, so that's now gone. And then they did allow you to transfer some. The problem with the FSAs which are different than HSAs, flexible spending accounts, which really don't have to be associated with a high deductible plan, can be applicable to any plan. Employers have to sponsor that, but allow you to put pre-tax money away. The challenge is, right, it's a use it or lose it. You have to use it up that year, although they do allow you to go an extra 3 months into the following year. But during COVID periods, they expanded that extension for the full year, but that's also ending. I probably should have pulled this slide out. But some more challenges. So the CARES Act basically allows employers to make tax-free payments toward their applied student debt, right, which was new, right? And that's going to be going through December 2025. Okay. They did, streamline the FAFSA. I've helped a couple clients recently, last couple of weeks, fill out their FAFSA. So they're trying to make that a little bit easier to do. And then they did change the mortgage insurance premiums, although that has not been extended yet for 2022 to have that be qualified residential interest. Next, we kind of get to the American Rescue Rep Plan. This was in the spring of 2021. A lot of this has to do with the child tax credit, which is actually going back in 2022 back to what it originally was. So a lot of this actually doesn't apply anymore. The dependent care expenses were also 2021 only, and then the discharge student debt will not be counted as income, okay, through 2025. So a lot of these provisions they had put in, right, are starting to phase out. And then the Secure Act, pretty much everything has sort of phased out, okay, or the most of it here. The Inflation Protection Act, which just was passed back in August. Okay, so some big changes here, outlining the Medicare prescription drug plan. So there are some changes, particularly insulin is going to be regulated in the price. They extended, as I mentioned earlier, they expanded the ACA subsidies, right, eliminating that cliff through 2025. They basically updated the residential clean energy credit, so you can take 30% of your solar costs, right, if you put a solar installation through this year. They've got some new clean vehicle credits, right? They've adjusted that program as well, but basically credit up to $3,750. Okay, and then there's limited. They've been phasing out the EV credits because more and more, electric vehicle cars are on the market. So basically, they're basically saying only the cars where the final assembly is conducted in North America, right, are going to be eligible for this existing credit. And now there's a used vehicle credit that's been introduced as part of this. So all this was part of this plan to try to, move us to a sort of more green, stance. A lot of energy type provisions in that law.
Excuse me, Bill.
Right. Yep.
So there's a question through the chat. It's from Juliet. It says, "Hi, Bill. Any new terms for 529s? Meaning you still have a lot of dollars there and your kids are done. Can we use it for other purposes like medical without a penalty?"
No, not that I'm aware of. No, you still need to. So basically, if you've got money left in 529, one thing you can do, obviously graduate school, right, is so your options are: one, graduate school is an option. You can leave it in the 529, and if your kids have kids, eventually you can transfer it and use it for grandkids eventually, right, and just let it stay invested the entire time. That's another option. Another option would be if it was a niece, basically as long as it was related to your beneficiary, like a niece or a nephew, you would be able to transfer the money to them and maybe work something out with your brother or sister potentially. Otherwise, you'd have to pull it out and have to pay the penalty and the tax on the earnings, right? Because the principal that was after tax money you put in, but then the earnings were basically tax free. So you'd have to pay a penalty and interest on the earnings portion of it.
Bill, thank you. I knew all that. Thank you so much. Do you know what the penalties are? I mean, I understand you have to pay taxes on the earnings, but do you know what the?
Yeah, I believe it's I'm pretty sure it's 10%, same as like an early withdrawal. So you have to pay taxes on the earnings and then 10% penalty.
Gotcha. Thank you.
Yep. Can we use it for ourselves? In other words, can we pursue a certification or our own degree?
Yeah, I think the issue with 529 has to be a degree program. But
okay.
But yes, you can. If enrolled in a degree program, you could use it for yourself. You're correct.
Oh, that's good. That's a great question. Thank you.
Yeah. You can use it for student loans though too, can't you?
Correct. That was the provision, right? They added that. I think it's up to $5,000 could be used for student
Sorry,
loans.
what was the question? Can you repeat it?
You could use it for student loans as well, if there was any student loans. Up to I think $5,000. Yeah.
So you mean a student loan repayment towards repayment?
Yeah, repaying the student loan, which is new. They used to not be able to use 529s for student loan repayment. I forgot. That's another option.
Okay, great. Thank you.
Sure. All right. So now these are sort of some tax planning strategies, basically. And the idea here is, when tax planning comes into play, is if you've got a big change in income, right, between years, right, and the reason that the whole idea is if that's the case, you want to pay the taxes, all right, in the year where it's the lower rate. So we do a lot of this work on the financial planning side with clients, not necessarily just in job transition, but really, well, I guess this job transition. Oftentimes clients in their 60s may either stop working full time or go part time, and they're going to hold off, for example, taking their Social Security until they're 70, right? Their required minimum distributions on their IRAs and the 401ks don't kick in until 72. So they may have, 3, 4, 5, 6 years where they're in a lower bracket. And so we spend a lot of time kind of managing, okay, when do we want to take the income, right? What income do we want to be aiming for? And a similar idea applies for folks in job transition. If you're going to have these big shifts in income brackets between years, right? So this is an example of, this is the year where you're in a lower bracket, right? So let's just say now, if you lost your position, you didn't get the job, the severance, everything out was paid out last year, and now you're in a lower bracket. So what are some things you could do, right? One thing, as I talked about, is if you have money in a traditional IRA, is you can do a Roth conversion. And for those who are not familiar, a Roth conversion is simply moving money from a traditional IRA into a Roth IRA. At that point forward, the Roth IRA is really after-tax account, will grow tax-free, but that distribution from the traditional IRA is income in that current year. So if you're going to be in the, you think, going forward, you're going to be in the 22% bracket, but this year you're only going to be in the 12% bracket, you might as well pay tax now at 12% so that you don't pay tax later at 22 when you have to pull the money out and you're forced to pull the money out, right? The whole idea is that when you're 72, you have to take the money out of your traditional IRA, whether you want to or not, at a certain level every year, and that will be income. And so you need to understand, what is your tax bracket going to be when you're after your age 72, and is that going to be higher or lower than today? And if it's higher, then you might want to pay that tax today, right, at a lower rate, essentially. Capital gains rate, if you're in the 12% tax bracket, pretty much, your capital gains rate is 0. So if there's been some stock you've been sitting on, right, that you really want to get rid of, but you never want to pay the tax on it, you might have a window to sell some of that stock, and basically it's capital gains, but the capital gains rate is 0. So you're not going to pay any tax on it. So there's an opportunity to get money out of your taxable brokerage accounts and not pay any tax on it. If you're over 59 and a half, just withdraw money from the IRA or 401k. I've had situations where clients are trying to save taxes in the short term by pulling money out of drawing down their taxable and their savings accounts, not pulling any money out of the IRA, and then getting whacked later, as part of the requirement distribution. So again, depending on your tax bracket, and you need money, even if you have money in savings, you might be better off pulling it out of the IRA and again paying the tax at a low rate. Okay. If you're, and I'll talk about one of the differences between 401ks and IRAs, but if you're 55 when you separate from service or older, you can draw money out of your old 401k and not pay that tax, unlike an IRA where you have to wait to 59 and a half. Okay, a lot of people are not aware of that. And then these are things like, these are probably not going to apply to too many people anymore, but because of the way the standard deduction is getting raised, and they have the limit on the taxes of 10,000. But if you're still deducting, taxes, and you pay estimated taxes for, you might have rental income or investment income, or you're self-employed for some reason. You pay estimated taxes. If you pay that in January instead of December, you're gonna take a deduction next year, right, instead of this year. And the opposite will be true on the next slide. But again, most people it's not going to apply to many people anymore, but it's certainly possible. Some of the credits that you in the past you would have never qualified for, right? The earned income credit, the American Opportunity Credit. If you're a high earning corporate person and now all of a sudden your income's low, you might qualify for credits that you otherwise wouldn't have. Just be aware of that. Okay. And then the next slide is sort of the opposite, right? This is the year where you're in the high bracket, right? So this might be the year that you actually lose your job and you're getting paid out a severance. Maybe you had a deferred compensation plan that you're getting paid out, whatever that is. But now you're in a high bracket and you want to obviously do the opposite, right? You want to lower your income this year and bring expenses into the current year, right? So obviously one thing, if you haven't maxed out all of your tax deferred investment accounts, IRAs, HSAs, 401ks, try to do that. Sometimes you have some choice, although that's less and less the case these days in terms of when you take your deferred compensation. I did when my job was eliminated. I had the ability to take some of that deferred compensation and defer it to the following year, which spread that income out a little bit. Again, if you're paying your mortgage, if you're deducting mortgage interest and it's still impacting your taxes, which again, I realize a lot of people, that's not the case any longer. But if you are, you can make your January mortgage payment right in December and take the tax deduction in December in the current year. Donor advised funds. So for those who donate money to charity every year, they have what they call donor advised funds, where you can act, which are really just charities that exist to give money to other charities. So let's say you give $2,000 a month out. What you could do is lump that together, give $10,000, for example, to the charity, take a tax deduction for that in the current year, and then spend the next 5 years giving that money out from the donor advised fund to the charity, basically. And this is also a strategy for folks to get around that, now where they no longer have a threshold. Let's say somebody has taxes at $10,000, property taxes, and they have mortgage interest for $14,000 or $12,000. So they're at $22,000. Well, the first $2,000 of their charitable giving doesn't help them on the taxes because it still puts them below the standard deduction threshold, right? Which is getting close to, I think it's 25 something now, right? And so, however, if they lumped all their charitable giving into 1 year, they could take a deduction for $20,000 or something, have that be tax deductible, and then just not, and then just don't give money from the donor advised fund, over the next X number of years. Now, trade-off is that money is given away. You can't get it back. You've made a donation to a charity. You can't get it back. You basically advise on where it goes going forward, but you can't get that money back for yourself. Okay. And these are sort of the opposite of what I was talking about earlier, right? You could pay your estimated taxes in December if it's still affecting your Schedule A, which again, it's not terribly common anymore, but if it is, you could just take that deduction sooner, right, and take it to get it at the higher tax bracket. And a lot of people were doing this, obviously, the year when the this law passed, right, and they knew that the following year they weren't going to have any deductions, and so they all rushed to get their deductions in the current year. Okay. And then the last thing you can do is sell an investment at a loss, right? So if you had something that has been, and this has actually been, I've been doing a lot of this, it's called tax loss harvesting, right? Where when the market's down like it is now, if you've got, let's say you own some mid-cap index fund, right? And that's been trading at a loss now because the market's down. You could sell that, buy a different mid-cap index fund. You can't buy the exact same one, but you could buy something different and take a tax loss. If you buy the exact same one, it's called a wash sale. And then, you can't take the loss, or you have to defer the loss into the future. But if it's the current, if it's, you could buy something slightly different. Or if you just have something that you've been wanting to get rid of, again, and it's going to take it at a loss, that's obviously up to $3,000 a year can lower your current income, and then anything beyond that will get carried forward and taken in future years. Okay.
Will, one question: this 3,000 is per transaction, or is on all the transactions that you did and you lose money?
I'm sorry. Repeat that again. The question.
Oh, can you explain a little bit the 3,000 cap?
Oh, the 3,000. So basically, if you have a net capital loss, so basically the way it works is, anytime you either have a capital gain distribution, right, on a mutual fund that you own, or if you buy or sell something in the year, you're going to have a gain or a loss. And what you do is you net all your gains and your short-term capital gains and losses. You net all your long-term capital gains and losses. If it's a net loss at the end of the day, when you net all that together, let's say it's a net loss of $10,000. Yeah. The IRS allows you to take $3,000 of that loss against your other ordinary income, right? Against your, whatever income you have, right? Employment, wages, anything. and then 7,000 will carry forward. So assuming you have nothing next year, you could take another 3,000 the following year, right? And now you have 1,000 left. You'll take that in the third year, and then it carries forward and it's
How
gone.
many years you can carry forward? Let's say you are 20,000 loss. Can you continue?
Yeah, it goes forever. Basically, there's no limit. You just I have people that are still taking losses that they took in 2008, right, from the big crash, and they still haven't used up all their tax loss carry forward. Yeah.
Okay.
So there's no limit. You got the rest of your life to use it up. Yep.
Yeah, excuse me, Bill.
Yes.
A question from just a couple minutes ago from Scott. Is 55 at time of separation for anyone or just teachers, etc.?
Oh, no, that 55 for the 401k is for anyone. So, and it's the year you turn 55. So let's say your job, you lose your job in, I don't know, March, and you turn 55 in November, that still counts. So as long as it's the end of the year, if you're 55, you can take money out of a 401k and not pay a 10% penalty, basically. But it has to be the 401k that you left separation on. So let's say you've got an old 401k that you never rolled over. It's still sitting out there from, maybe you left there when you were 40 or something. You can't take money out of that. And you can't take money out of a 401k where you're still actively working, even if you're 55. That doesn't work. It's only in the situation where you've turned 55, you're separated from service. And so I'm going to get into that in a future slide here, but you generally want to hold on to that 401k until you turn 59 and a half, so that in case you do need to pull some money out.
And does that same rule apply for 403b?
I believe it applies for 403bs as well. Yes.
Yeah, which is not-for-profits and teachers and things like that. Yep.
Then that's okay. So let's get to that next slide that I was talking about. So what are the advantages or disadvantages of 401ks versus IRAs and 403bs, which essentially have the same rules as 401ks, okay? Well, so there's really, I see two advantages to 401ks. One is that you can borrow against a 401k. So those not familiar, you can borrow up to 50% of your vested balance or $50,000, right? Whichever is lower, essentially. And so that could be an option. So now that will typically not be an option for your old 401k, right? Typically, companies, once you leave, are not going to allow you to borrow money because they basically gets paid back, right? Usually through payroll deductions. So if that's the situation, you think you might want to borrow against the money in your 401k, you want to wait till you get a new job and roll that money into the new company 401k so that you can borrow against it, okay? The second scenario is the opposite, right? The one I was just talking about. If you're in this age 55 and now you can take money, that's only out of the old 401k. If you roll to the new 401k, you can no longer do that, right? So that's a situation where, again, I've had a client in the past where, an advisor wanted to get a hold of their money, and so they advised them to roll to an IRA, and then they need to take money out, and then they incurred a penalty. Whereas if they just left it in the 401k in the first place, okay, they could have done it. Now, you could theoretically do the opposite. Move money, I believe. Well, it depends on whether the company would allow it, but then you're probably getting tricky whether you can move money from an IRA into that old 401k. But I guess that doesn't really accomplish it. But I'm not sure. That probably wouldn't be allowed, but you could try that supposedly. If those two don't apply, those two situations, then it's generally better to roll money into an IRA. There's a number of advantages on the IRA side. One, probably doesn't apply to a lot of folks here, but we've got, if you're a first-time home buyer, you can take up to $10,000 out of an IRA. You can't out of a 401k. The second one can apply. I mean, I actually did this myself, which is you can take money out for higher education expenses. As long as qualified higher education expenses, you can take money out of an IRA and not have to pay the 10% penalty. You have to be careful not to double dip, right? You can't use money coming out of a 529 for that same money, right? You got to be somewhat careful on what it is. It can't be a double tax benefit, essentially. But the thing to be aware of is that is income to you, right? When you take money out of an IRA, and therefore, if you're qualified for financial aid, be aware that that could have an impact on your financial aid. So, with a couple clients, what I recommend they do is they wait to the last years of their youngest student, where now their income no longer mattered, right? Because it's the FAFSA looks 2 years back. So that last couple of years, the income in those years don't affect the financial aid typically. And so, those are the years to pull money out of the IRA to use to pay. Okay. As I mentioned earlier, right, if you're unemployed for at least 12 weeks, collecting unemployment, then you can take money out of an IRA, but not a 401k, and not pay the 10% penalty to pay your health insurance premiums. You have much broader investment options. Now, some 401ks come with a brokerage option, but most don't. And, you're limited to whatever the, registered investment advisor for that plan kind of came up with as options, right? Whereas with a brokerage account, you could buy anything out there that exists, right? Now, you got to be somewhat careful, right? If you're taking money out of a 401k and giving it to an advisor where they're going to charge you, 1%, and you're in high fee funds, you could end up paying more than if you had just left the money in the 401k. But if you get the money out of the 401k and you move it to Vanguard or Fidelity, invest in low cost index funds, you're typically going to pay less. Okay. And then, as I talked about earlier, Roth conversions are a strategy that really only apply if you have an IRA. So if for some reason you want to bring your income up because you're in low bracket or whatever that is, or you want to get out of Medicaid, whatever that might be, then you sort of have to have money in an IRA to be able to do the Roth conversion. And it also, it depends on the company, but because they really have some discretion here, is you don't necessarily have to do all of everything, right? You can do a partial rollover if the company allows it, put some into a 401k, put some into an IRA. It all depends. You may have that flexibility.
There's a comment, Bill, or question from Joe.
Sure.
My understanding is you can move dollars from a rollover IRA into a 401k as long as it was all 401k money in the rollover IRA. If you contribute $1 of your money to a rollover IRA, then it's no longer a rollover IRA.
I'm not 100. I'd have to check on that. I guess I can't say with 100% certainty that is the case. I didn't think that was the case. That I thought, it was really more of a question of whether the company allowed you to roll over money in. I'm not sure the IRS cares whether it was a pure rollover. It would really more, it's my understanding of the difference between a rollover IRA and a non-rollover had to do more with liability, right? In other words, meaning there are slightly better protections, although a lot of that's been, whittled away for a 401k versus IRA in terms of if you were getting sued. And a rollover IRA, a pure rollover IRA, right? We rolled over has basically the same kind of protections, liability protections that a 401k has. Whereas if you mix your own money in, but I didn't think that had anything to do with be able to roll it over into a 401k. I'm not saying that's not true. I don't know for sure, but that wasn't my understanding. But I could look into that.
That was explained to me, I'll say 22 years ago when I first moved from a 401k into a rollover IRA, that I could then roll it back into a 401k. They could have changed.
Yeah, I'm not 100% sure. That may be true. I'm not saying that's not true. I haven't had anybody try to do that where I had to really research it, to be honest. But I'm not aware of that. But it could be true. Yeah, it could be true. Okay. I'm not sure.
Because that would be a loophole in that 55 category. You roll everything. Let's say you have $1 million.
Yeah, that's what I was talking about earlier, right? Yeah, in theory, if they allow it, you might be able to roll over and get money in to take it out of the 5. Yeah, the question is going to be if you've left the company and you're no longer employed, are they likely to let you roll money into the 401k? I'm guessing no, but it depends on the company.
Well, if you're laid off at the end of this week, then you have a 1-week window to do it.
Yeah, possibly. Yeah, that's why I say it's a possibility. It's something to look into, but I'm not. It all depends on the company and what they allow.
There are games that you can play there. Okay.
Yeah. These are just some topics on debt. Some things to keep about if you're, obviously in a tough spot and you're having to take on debt. Clearly you want to tap your lower rate sources of credit, right? Things like a home equity loan, if you can qualify. If you have a home equity, line already set up, it's kind of hard to get, obviously, if you're not working. But if you've already got one set up, you could tap into that. It's typically going to be at a lower rate. If you've got a whole life insurance or something that's got some cash value, typically you could borrow against that. The rates have gone up, right? So I used to be able to say it was a low rate, but not so low anymore, right? Same thing with home equity. A couple years ago that you could borrow from a cash value for 4%. I doubt you could do that today. But it's certainly an option, and it's certainly lower than what you'd have on a credit card. Credit card obviously typically going to be the highest rate debt. And understanding that even within credit cards, they have different rates between cash advances and purchases. So be aware of what rate it is that you're paying. Just in general, right? It's good to keep an eye on your credit reports. You're allowed once a year to pull your credit reports from the 3 credit bureaus, which is different than your credit score. right? So the credit bureaus, right, TransUnion, Equifax, Experian, they're basically huge data collectors, right? They're collecting all this data on your credit history, right? All the credit card companies, every reports, whether you're making your payments on time and how much, debt you have relative to your outstanding credit line, all that kind of stuff. They're collecting all that data. Then an algorithm gets run against that data to come up with a score, right? The most well-known one is Fair Isaac's called FICO score. FICO made a lot of money on that algorithm, so the credit bureaus got together and came up with their own algorithm now called Vantage score. So, oftentimes if you get if your credit card company gives you, a free look at your credit score, if you look at the fine print, you'll see that's Vantage score, not the FICO score, because it's, less expensive. It's, profitable for them. But banks generally use the FICO score. So that sometimes is a little bit harder to get your hands on. Sometimes you'll have to pay for it. But at a minimum, you could at least look at the credit bureau reports themselves and make sure nothing erroneous is on there. We did have an issue with, my wife and I went to get, refinanced, where there was some debt, medical bill that we had long since thought was paid off and all settled that was still showing up and created all kinds of problems. We had to get it resolved. But so it's a good idea to go in there and check those. Obviously, if you're getting close to your credit limit, that's going to have a negative impact on your score. Generally, 30. You want to keep your revolving lines below about 30% outstanding if you're trying to maximize your credit score. Just paying the minimum due has a negative impact on your credit score, and obviously, missing a payment and certain anything goes into collections is going to have a big impact on your credit score.
Bill, there's another type of loan that doesn't show up on your credit. If you have a regular brokerage account, some of the brokers will let you borrow up to 50% of the value. And
correct.
There's no minimum payment, but if you don't pay that month, the interest gets rolled in as principal. It's a very slippery slope. You've got to be careful, but
right.
It doesn't show up on credit reports. It doesn't show up anywhere.
Yeah, no, I probably should have mentioned that on that top limit as another source of income if you've got a brokerage account. The same thing is true with a cash value loan. So if you borrow against, let's say, a whole life policy, that does not show up on any. There's no credit report run. Doesn't show up anywhere. So you could, borrow that and not have to worry about it having an impact on your credit. Yep. College, couple of comments on college. Obviously, if your situation has changed and then you had this corporate job when you filled out the FAFSA and now you don't, you can certainly go to the financial aid office to see if there's any adjustment they're willing or able to make. It all depends on the school. Some will, some won't. Generally, private schools have more flexibility with their financial aid than public schools as a general rule. But you're certainly not going to get anything if you don't ask, right? So you want to reach out. And it's just more of just an overall topic. I think a lot of people think, oh, my student's never going to get financial aid because of our income. But really, most of the financial aid given out there is merit-based, not need-based. And so really what merit-based aid is just a discount on tuition. So they really want your student for whatever reason, right? Most often academics, right? Students in the top quarter of the class, right, essentially are going to help that school's overall profile. And so they're trying to entice those students to come. So essentially the students in the bottom half of the class, right, are subsidizing the students in the top quarter of the class. And so for every student, there's going to be some school where they're going to be in the top quarter of the class, right? So it's just a question of being, kind of casting a wide enough net to consider, what school is really going to want this student. It could be academics, could be like I had a situation where a student, their daughter was a violin player and the orchestra really needed a violin player. And so they threw a nice aid package at her to get her to come. Could be geography. We used to be we are friends with somebody who used to be the admissions person at like George Washington University. And they had like students from 49 states, right? And they wanted somebody from Wyoming so they can say, hey, we have students from all 50 states here. And literally, if that person from Wyoming, applied, they were going to throw the ranch at them to try to get them to come, right? So, we did that. We used to live in Minneapolis. Minnesota schools are really not on the radar with New Jersey students. And so we applied to Minnesota schools and both my sons got nice merit aid packages from Minnesota schools. Because again, whereas in Boston, they're inundated with students from New Jersey. So it's not a big plus necessarily coming from New Jersey if you're trying to go to school in Boston, for example. So just be aware of that. And as I mentioned earlier, you can take money out of an IRA and not incur the 10% penalty if it's used for qualified higher education expenses. Okay. The next slide was kind of my rant on investment fees. You know, people think, oh, I'm going to pay 1% to have my portfolio managed, and just be aware that 1% really adds up over time. You know, we're personally big believers in what they call index funds. These are low-cost funds. Essentially, like for example, for large cap fund, if you own the entire S&P 500, right, for example. You know, there's a computer, right, just owns the 500 stocks. There's nobody doing all this research or anything else. And as a result, they're able to keep the fees super low, 0.02% or something, right, depending on which one you get, right, but really low versus you might pay 0.8% or something for somebody who's managing, right, hiring staff to analyze companies. And the problem is it's very, very difficult to beat the market because it's a zero-sum game, you know, besides what the market goes. So as long as there's enough people out there, you know, doing all this analysis, it becomes a reasonably efficient market. Then essentially everybody who buys a stock, right, and does all that research, somebody's on the other side of that trade, and they did all the research and decided to sell the stock. Well, one's right and one's wrong for that particular trade, and that balances out. So on average, right, people managing these money, essentially half of them are going to be above the market and half are going to be below the market, simply because the market is the average of all the decisions all these players are making. And that's before fees, but they're charging you a fee to do that. So only about 30%, you know, beat the market enough in a given year to justify the fee that they charge. And over time, because it's different people every year, that drops to about 18%. So it's very difficult to beat the market over the long term. And so our philosophy is forget all that. Just don't pay that fee and just pay, you know, buy low cost index funds. And that, you know, as you can see in this chart, even with a $250,000 portfolio, that 1% over 30 years will compound and have a, you know, reduce your ending portfolio by about $600,000. So it's pretty big numbers when you get to it. Although it seemed like a lot at the beginning, it compounds and you get that compound effect. Okay. So just be careful of the fees is, I guess, the gist. And then my last rant is on Social Security. When do you take Social Security? You know, a lot of people are worried, well, hey, I paid all this money in. I want to make sure I get my any out. But, you know, what is the break even? But, you know, our thinking is that's not necessarily the best way to think about it, right? When you're trying to fund your retirement, what you really want to do is no matter what the situation, you don't run out of money. That's the idea, right? And so let's say, for example, I have a situation here where somebody's taking it at the earliest possible age or at the latest possible age, say 62 or 70. Now, if you knew in advance, right, that you were going to get hit by a bus at 72, then you clearly would want to take it at 62 and you'd make more money, certainly, right? On the other hand, if you knew you were going to wait till you're going to live till 95, you would be much better off waiting because for those who are not aware, right, Social Security grows about 8% a year every year that you wait. That's not an 8% return, right, because you're getting it for one less year. You know, the break even's around 5.5%, 6%, right, and just in terms of getting it one less year. But it's still it still works out in your favor, and especially since it's inflation adjusted, and people are seeing the benefit of that, right, in this last couple of years of having inflation adjusted Social Security. But the gist of it, if you knew that, but you don't know, right? So what happens if you're wrong? Well, let's say you did the thing where you waited till 70 and then get hit by a bus at 72. You didn't make as much money from the government as you could have, but in theory, you should not have run out of money at 72 if you plan for any kind of a reasonable retirement, right? On the flip side, the upper red box now is somebody takes it the earliest possible date and lives to 95. Now they're living on a pretty limited income. And this is honestly the retirement crisis in the United States, right? About half the people take it at the earliest possible age. Some people have no choice, in all honesty, but some people do. Take it at the earliest possible age, and then one of the spouses passes away, and then you have the surviving spouse, often the wife, you know, living on, say, $25,000 a year, right? And that's essentially what these, whereas if you have two corporate people and they wait till 70, like two people have made more than 100,000 for a number of years, they're probably going to get now about $100,000 a year in Social Security. That's a pretty solid retirement just from Social Security without even having to touch your portfolio. So it's generally, for most people I work with, it's generally better to basically, doesn't mean you got to work till 70, right? You can retire at 62 or 63, but then just live off the portfolio, right, from 62 to 60 to 70, and then draw Social Security, and it actually takes the pressure off the portfolio for the rest of your life. It is actually a safer way to manage for retirement, essentially. So that's to be aware of. Yeah. And I think that's what I have, unless anybody has any questions. Here's our contact information.
Yeah, folks, if you have a question or two, just quickly unmute and
Well,
excuse
and I can
yourself.
just turn this off here, but
Well, you can leave the slide up for another few minutes.
okay, sure.
One small side note with the Social Security, if you had a spouse or ex-spouse that passed away, I believe you're allowed to collect half of their social starting at age 60 and let yours build up to age 70.
That's correct. You used to be able to do that. Even people, spouses that were married used to be able to do what's called file and suspend,
Okay.
where you would file on your spouses. Really, you do it at full retirement age. But now the only exception left that still works, unless you're grandfathered in, is going to be the situation where you're a surviving spouse. And yes, you can file. I have a client doing that, right? They file on their ex-spouse's record, let theirs grow, and then when they get to 70, they're going to flip the file on their record and collect theirs for the rest of their life. Yeah.
Okay. The other small caveat is if there's an underage child under the age of 18, that
Correct. They
child,
would also, yeah, up until 18, you could collect a survivor benefit as well. Yeah.
well, it's 18, and if they're a graduating senior, then they can be 18 for those few months until they graduate.
Right. Yep. So, all right. Anything else?
Anything else, folks? Bill always covers a tremendous amount of information, and no pun on the financial advisor, but it's a wealth of information. And, if some of this went by a little quickly, you just need a quick question to clarify a point, please feel free to do so right now.
Yeah, I do have to talk fast. I apologize. I probably should apologize in advance.
Okay.
Yeah.
Something that somebody else has brought up, I don't know if they want me mentioning who it was, about long-term care. And they actually just sent me an article about Washington State now requiring long-term care insurance, and that New York and some other states may be following suit.
Yeah, I'm
They're going to
guilty.
require they buy long-term care insurance?
Yeah.
Yeah, it's the article I sent you, Bill.
Yeah, I have
Yeah.
to look at that. Yeah.
Yeah, that's going to change the playing field there.
Well, yeah, that's got to be a funded program, though. I mean, they can't force somebody to buy private insurance. I have to look. Yeah, I guess I didn't look in time to look into it, but yeah, it's got to be some kind of a publicly funded thing, I would imagine.
Well, there's a payroll tax if you don't have it in Washington. I think it's 0.58%, and
Oh, all right. I should definitely look at that and see. I mean, there's an argument for that, right? Because right now it's unfunded, and basically unless you want to pay for it yourself, or you rather need to pay for it out of your assets, right? Buy long-term care insurance, which is very expensive because like 70% of the people are going to need it, right? Or you draw down all your assets and then go on to Medicaid. Which now you're talking about going into a facility you really don't want to be at. And we're just with some friends of ours, a woman who's an occupational therapist, and was saying that some of these Medicaid facilities are just awful places, and so it's a tough one. So yeah, if there's states out there trying to innovate around that, I ultimately probably think that's a good thing, but I have to look into get some of the details. Yeah.
Yeah,
Well,
certainly we think about long-term care insurance as a possibility when we get older, and it becomes very expensive as we get older. So any of us that have children who are maybe in their 40s, you may want to ask them to look into it now. It'll be a whole lot less expensive to purchase it while they're younger. Like a life insurance would be similar, but life insurance costs more when we're older than when we're younger.
Just as an aside, this Wednesday, PSG of Morris County is going to be talking about this subject. Open mic starts at 8:30, and Jerry will be talking at 9:30.
Yeah, one thing that's not in there, if you're trying to plan with an interest-only retirement and have enough coming in, technically you could self-fund such an insurance if you have enough coming in, get around the whole situation too, and then you.
There was one more point I forgot I was going to make about the long-term care, but shoot, now come back to me. But yeah.
Well, one of the issues
Maybe it's time for a new slide.
last about 3 years.
What
Yeah.
was that, Carol?
Well, I just didn't do it just because. I know what I was going to say because you mentioned David age. Yeah, I did do an analysis a while back that said 55 was sort of the sweet spot, right? Before 55, right, you're paying that many more years and it didn't justify. But after 55, the premiums really started to rocket up. So it's really in your 50s when you sort of want to decide. The issue is, and the other issue is for women, the premiums are almost double what they are for men, right? Because women tend to outlive men. They're the ones who are taking care of the husbands. And so where I've seen it make the most sense to buy the insurance is when you have a single man, didn't have any kids, not particularly worried about leaving money to anyone. Then they can manage that. You know what you're going to, it's fixed, right? You know, you're going to pay that long-term care premium and that's going to cover, a big chunk of it. And so therefore you could spend, because there is some leverage, right? And the fact that if you don't use it, somebody else uses it. So there's some leverage. It's just not as much leverage you get on something like fire insurance, where everybody pays a small amount, and the person's house burns down gets a big check, right? With long-term care, with 70% of people needing it, it's a lot trickier to make the math work.
Question going back to Social Security: what is the benefit, the college benefit to a surviving dependent?
You say college, you said?
Yeah.
I don't believe there's anything related to college specifically.
I thought this is going back a while. My friend's dad died back in 95 and his younger brother was under 18. And there was something about he had free college or something because of his dad dying.
I doubt that was from Social Security. That might have been, I don't know, something he had from where he worked or something. I'm not aware of that. I'm not saying 100% true, but I have never seen that. My understanding, is that surviving children will get a survivor benefit, and there's some formula for it, right? Up until they're age 18, essentially.
Okay.
Yeah. All right.
All right, folks. Well, Bill, thank you so much. Always, pun again, a wealth of information, but this is always very important. One of the things we've shied away from are having wealth management presentations, and that's not what this is, and that's why we appreciate your perspective on these. These are really things to think about. Certainly managing expenses when we're in a career transition, but really for the long term, even once we get back to work, all valuable things, because when your income changes and goes back up, you have to rethink your approach to a lot of these points as well. So it's good that these are presented to us, and we're so appreciative of you being a
friend. Sorry I was late. I'm out in Minnesota meeting with some of my Minnesota clients, and that the 1 hour time change threw me off. So I should have figured that out by now, but I didn't, so apologize.
Yep, no worries at all. Well, that won't be a problem next year because daylight savings time is going to be put it back into effect in March, and we will not be falling back any longer. So all will be good next year. We'll schedule you for daylight savings time when it would have ended next year, and there won't be a problem.
Yep.
Good. So let me just quickly let you know that next month we will be right back here. As you know, the Breakfast Club of New Jersey meets every second Saturday of the month. And so we'll be meeting on December 10th. Deborah Wheatman will be here to be talking about professional branding. Really a terrific topic. And, one thing, the silver lining with these virtual meetings, I think we would like to get back to in-person one day soon. But the silver lining, we get to have people visit us who can't visit us in person. So Deborah Wheatman is from Florida, and she always does wonderful presentations. And so hope you have the opportunity to be with us next month, December 10th at 8 o'clock in the morning. And before we sign off, Frank, if you're still on the line, if there's anything you'd like to say as part of wrap up.
I'd just like to thank Bill. He freely gives of himself to all the Breakfast Club members for many years. And, it's a desperate time for those that are in transition. And I thank him for all he does in sharing his knowledge freely.
Great. Thank you very much. And, the same goes true for Frank, continuing to support and run and lead this group for all this time, freely giving of your time to help the folks as well. So we're certainly appreciative of that.